Good afternoon and welcome to today's Learn at Lunch webinar. Today, Amy Hagerman, OSU Extension Farm Policy Specialist, will discuss the recently passed Farm Bill and what this means for Oklahoma producers. If you have questions, please ask them in the chat box in the lower right-hand corner. Additional information and resources may be found on the Ag Policy and eFarm Management websites. I will paste the links into the chat box. Amy, I will turn it over to you now.
All right, thank you. It sounds still good?
Yes, it sounds good.
Excellent. All right, well, thanks everybody for attending this afternoon. We're going to go through some of the processes that have got us up to this point on the Farm Bill. We're also going to talk a little bit about some of the next steps, what we can expect to see happen. I'm going to go through some of the changes that I think are going to have some impact for our producers here in Oklahoma. I know I've been kind of out on the road giving Farm Bill updates for a while, so if you've had some questions, maybe since the last time you've had information on the Farm Bill, please feel free to ask. I really want to start getting down into some more details now as we can. But of course, we're still waiting on some information. So where are we at on this Farm Bill? You guys may have seen this figure before, but this process started, well, quite a while ago with the listening sessions. But the first bill was introduced by the House Ag Committee in April of 2018. That bill failed the first time it went up for a vote, but it passed June 21st, and a version of a Farm Bill passed June 28th in the Senate. And then in late July, early August, both the House and the Senate committees voted to send those two versions of the bill to a conference committee for reconciliation. That kicked off on September 5th. They worked through the differences, the details, and there were some pretty significant differences between the two versions of the Farm Bill. A lot of attention was given to the differences in the nutrition title of the Farm Bill, but there was some differences in conservation and commodities as well. And we've really seen some things come out of this conference report that are pretty significant differences, even from the language that was in the HR2 and the S3042. So that conference report was signed, indicating that the conference committee had come to an agreement. That was signed December 10th. It moved rapidly through a full House and Senate floor vote and passed with a very strong majority. And if you followed the news, you know that this is actually quite a big deal, the majority by which this bill passed. It actually leapfrogged a little bit. Usually the House votes first and then the Senate, but in this case the Senate leapfrogged and voted first. On December 11th, the bill passed 87-13, and then on the House side, it passed December 12th, 369-47. And just, again, that's a really strong indication of support for agriculture. The bill went to the White House for signature on December 20th, and we had a farm bill by the end of December. There were a lot of people who really didn't think that they were going to get a farm bill. By the end of 2018, this moved pretty rapidly as compared to the prior farm bill, but not as many changes were made in this farm bill as were made in the prior farm bill. This one looks quite a bit like the 2014 farm bill. So where we're at now is that the bill has gone to USDA, who now has the job of interpreting the law and turning it into program guidance. And so that's when we'll really get a lot of the details about how these laws are going to be interpreted and moved into the implementation phase. So just a little overarching, this is an $867 billion projected spending farm bill. This is very similar to the amount of money in the previous farm bill, and this is what's called a baseline farm bill. There was no expansion in the amount of money that was available for these programs. So the big four still account for 99% of spending: commodities, crop insurance, conservation, and nutrition. And actually nutrition alone makes up about 79% of all farm bill spending. Everything else fits into that last 1%. Trade, credit, rural infrastructure and development, research and extension, forestry, energy, horticulture, and then the miscellaneous title, which we're actually going to talk a little bit about some of the things that are in horticulture and miscellaneous this time around, which you don't always get to do very much in a farm bill. All right, so let's talk a little bit about the commodity programs, because I think we've got a lot of producers that are really interested in what happened here. There was some discussion around eligibility requirements and adjusted gross income limits for eligibility. No changes were made in that area. So the conservation requirements, the active participation rules, and the adjusted gross income limits were all maintained from what they were in the 2014 Farm Bill. The one expansion in this sort of general overarching eligibility area is that the definition of family was expanded to include first cousins, nieces, and nephews. And what this really goes to those payment limitations, where each individual in the pass-through entity has a $125,000 limit. So who can be a part of that pass-through entity is the question here. But again, that's the only change that was made in that area. In terms of ARC and PLC, our safety net programs, the ARC PLC election will be for 2019 to 2023. Producers can make a new election for that entire 5-year period. However, at their discretion, they will have the option to switch that election after 2021. So let's say they look at the next few years and they say, you know, for my wheat base, I want to put it in PLC. And so they'll sign up 2019 to 2023 for PLC. And again, we have to wait for USDA to say exactly how this is going to look, but just based on what's in the Farm Bill, it looks like they would sign up for 2019 to 2023 to put their wheat base in PLC. But we get along and prices start to go up and they begin to feel like, say, in crop year 2021 or 2022, that they actually want to change over to ARC. They will have the option to do that. Now, there's going to be no sort of prompting, no signing back up, or re-electing, I should say, that they will be asked to do. It will be at their discretion to go to FSA and ask to have that election changed. That's how the rules read right now, based on what's in the Farm Bill. Another change that was a fairly big change, kind of overall to base acres, is that although there is nothing in there about reallocating base, and again, we don't know what USDA is going to come back and say on that, but in the Farm Bill, there is no language to indicate that base would be reallocated. However, for land on a single farm that has been in pasture or grass from 2009 to 2013, they can keep the base, but they can't change their ARC PLC election, and they can't receive payments under ARC and PLC. So what does this mean? This means, let's say you've inherited a piece of land, it's under an individual FSA number, it's got some peanut base on it, but you've had it in grass since you inherited it in 2006. That's the kind of land that would fall under this umbrella. If any covered commodity was planted on an FSA farm number at any time in that time frame, they would still be eligible to sign up for ARC and PLC on this. So what is their alternative instead? Their alternative instead is to sign up for this grassland incentives program. We're going to have to wait and see what the final title of that is. It's going to be under Conservation Stewardship Program money, but it is not tied to the requirements of the CSP. So it's not going to be like signing up for an improvement program under the CSP. It's its own individual thing at a rate of $18 per acre, which is actually outlined in the Farm Bill. And it is still a working land program, so they can still graze cattle on it. It's not like CRP in that sense. So I think that's going to be an important change for some of our producers here in Oklahoma, and I've got some research ongoing to try to figure out just how many acres we might really have fall under this. Okay, so specifically in PLC and ARC, there's some changes that are made in how those levels are calculated and how they might trigger over time. The first, that there was a lot of questions associated with reference prices. Were reference prices going to increase under PLC? So of course the reference price is PLC triggers when price is below a reference price. So reference prices will remain the same, except when prices start to go up. Okay, so kind of break this down into pieces. So they're going to look at a 5-year rolling marketing year average price. and they're going to take 85% of that 5-year rolling average price. When the reference price is lower than that level, then it's going to default over to 85% of the 5-year rolling average price, an effective reference price. However, that effective reference price can't go up over 115% of the reference price. So we take the wheat reference price of, I think it's $5.50, and then you can think, okay, you could have $5.50 or it could go up with this effective reference price. We would have to have several years of higher wheat prices for it to trigger this in wheat. But then it could go up as far as $6.33. So that's kind of this, what they're calling escalators for the reference price that would allow the reference prices to go up. And when PLC was triggered, it would pay a little bit more under that. Then also under the agricultural risk coverage, or ARC, there were some changes. The first is that the ARC individual, which was the option to sign up all the commodities, all the base acres you have under ARC IC and be kind of associated just with the information on your farm, that's no longer an option. It had very low sign-up rates. Less than 1% of acres nationwide were signed up under the ARC IC program. Also, for the ARC CO program, which is continued, that was the one that most people signed up for if they signed up for ARC, is they signed up under the ARC County program, county coverage. So the risk management agency data is going to be used for ARC CO going forward, as opposed to the National Agricultural Statistics Service data for yields. Why is this important? Because they're trying to reduce the times where you have one county that has an ARC yields. Why is this important? Because they're trying to reduce the times where you have one county that has an ARC payment triggered and a county next to it that doesn't. They're trying to reduce those jumps that happen. So they're going with the crop insurance data in hopes to reduce that from happening. Another change under ARC is that they're going to break some larger counties up into multiple ARC payment areas. Again, trying to reduce the effect of those averages being used at the county level. So for counties with more than 4,000 square miles and more than 190,000 base acres, they might be selected for one of those 25 counties. Yes, we have 3 counties in Oklahoma that fall into those 2 4,000 square mile, 190,000 base acres requirements. However, they're going to target counties that have very different climate or soil types in the 2 halves of the county. So you can think of something that's like up against a mountain range as a good example, I think, of the kinds of counties they may target. But it's just a matter of awareness that they may break some counties into 2 payment areas. The biggest change I could see affecting ARC is going to be this update in yields. So for farmers, this is particularly going to be true for farmers affected by severe drought, but don't misinterpret that bullet. All farmers will be able to do a yield update. It's just, I think that farmers that are in areas and counties that were affected by drought are going to benefit most from this yield update. The other thing is that marketing loan rates have increased. Of course, marketing loans have gotten a lot of attention recently because of the shutdown and whether the timing of those loans. But there were some increases in the marketing loan assistance programs for loan rates from 2019 to 2023. I put up a few examples here so you can see some of those increases. You know, you can see corn and grain sorghum going up from $1.95 to $2.20. You can see soybeans going from $5 to $6.20, and you can see wheat going from $2.94 to $3.38 per bushel. So I think that that's something that producers can be aware of as they start looking to doing maybe some marketing loans in the next year. And again, this was just a view of those counties that were affected by drought, and I really think we've got a lot of counties in Oklahoma that would have drought pulling down that county average yield number, that being able to do that yield update, they would really benefit from that. Okay, so let's talk a little bit about livestock programs. The first is if you got any dairy in your county, Dairy safety net was strengthened. The margin protection program is actually going to be renamed the Dairy Margin Coverage Program. The idea is to lower cost for the smallest producers and also lower insurance costs for the largest producers. They're also going to look at possibly refunding some of the overpaid premiums in the old MPP program, and people get a little bit more money back if they use the money to buy future coverage as well. Then also for disaster assistance, this was a really important program in Oklahoma, this livestock forage program. We had some of the highest payouts over the last couple of years. We had some of the highest payouts in the country on the livestock forage program. In 2018, I think we used about 40% of the total payouts that occurred in the nation were to Oklahoma producers. So this was an important program for us. The Farm Bill does maintain the livestock forage were to Oklahoma producers. So this was an important program for us. The Farm Bill does maintain the livestock forage program if we have more droughty years, and there are producers who need to use that. Another change that happened over the course of several bills, starting with the Bipartisan Budget Act that occurred in February of 2018, is that previously the LFP payments, the LIP payments, and the ELAP payments could all sum together had to be less than $125,000. There was a single $125,000 payment cap that applied to all three. Well, now, because of some changes that happened, there's a single cap that applies to LFP alone. And then LIP, the Livestock Indemnity Program, and ELAP both have no cap on their payments. Why? Because these are really extreme disaster programs. These are things like the wildfires that we experienced in Oklahoma. The LIP program pays for disease and deaths of both adult animals and now unweaned livestock. That wasn't covered prior to this Farm Bill. It also includes payments for animals that were injured and have to be sold at a discount. Well, how does that work? They take the LIP payment amount, which is set and fixed, across an entire year, and then they subtract off the amount that animal received at auction, its salvage value, and it pays the difference so that an owner can still sell their animal at auction even though they're injured, and they would still get the full LIP payment amount. But it costs a little bit less to the government, and it allows that animal maybe to go on into some kind of productive life and not just have to be put down. It also eliminated, the Bipartisan Budget Act eliminated the payment limit for ELAP as well. So emergency response, there was also funding in the Farm Bill in that miscellaneous title for emergency response. It included establishing an animal disease preparedness and response program, which is going to send funds to states for emergency response. It establishes a U.S.-only vaccine bank that will begin with foot and mouth disease vaccine, and it expands support for the National Animal Health Laboratory Network, which is the state labs in effect. Okay, so let's talk a little bit about conservation. This was an area that had a lot of discussion around it, and some of the compromises that happened in the conference report happened in the conservation title. So CRP acreage was increased. This is the first increase we've had in a couple of farm bills, from 24 million to 27 million acres for the cap. And then also the rental rate was decreased from 100% of the county rental rate to 90%. What does this mean? They were trying to make CRP compete a little less with active land use within the county, renting that land out. Other things, the Environmental Quality Incentives Program, which is used quite a bit here in Oklahoma, actually saw increased funding for this Farm Bill cycle. The Conservation Stewardship Program, which there was actually a proposal to eliminate the CSP program, but it was maintained, but it did have a funding decrease in this Farm Bill. The easement programs and the regional conservation partnership programs were also maintained for this next Farm Bill. There was also some additional funding provided for infrastructure initiatives. For example, flood prevention, watershed rehabilitation. We definitely have some conservation districts in Oklahoma that have some of these projects ongoing. And for watershed rehabilitation, we definitely have some conservation districts in Oklahoma that have some of these projects ongoing. And for our producers that are in counties dealing with feral swine eradication pilot was funded for threat assessment, control methods, and land restoration. And so we could expect to maybe see some money coming to states to help with that. Okay, talk a little bit about crop insurance. Not a lot of changes in crop insurance. That was one of the feedback items they received in the Farm Bill listening sessions prior to drafting this Farm Bill. And so we don't see a lot of changes there. It maintains a lot of the policy options your producers might be used to, including the supplemental coverage option that goes along with PLC. There were some changes made to the Whole Farm Revenue Protection Program, but it's not a heavily used program because of some of the technical details in it. For producers who graze their cropland part of the year, like our winter stocker producers, though, there was a change in crop insurance that I think is pretty meaningful. It's that separate policies can be purchased for grazing and crop purposes. So let's say you've got winter stockers on wheat and you want to purchase a rainfall protection policy for a certain portion of the year, those 2-month intervals. You can purchase that and still have a grain policy for your wheat, and could potentially be paid out on both, depending on what happened in that year. So I think this is a pretty important change for some of our producers here in Oklahoma and something to watch carefully. There's also some research and development monies in there for new insurance policies, including sorghum and for farms that use more efficient irrigation systems. Again, there were some changes in whole farm revenue protection, trying to make that a little more viable, especially for beginning farmers and ranchers. Also, that industrial hemp cropland would be eligible for crop insurance. We're going to talk more about that in a few slides from now, but just to be aware that is in there in terms of crop insurance. There's a lot of data needs associated with any kind of new insurance policy. And so I always want to warn people to just have some patience, because risk management agency is going to need some time, and this is not a crop that has a lot of data for it in many regions. So just be aware of that. Okay, now to just dive right into that. So industrial hemp, the horticulture title contains a section that legalizes industrial hemp production as an agricultural commodity by removing industrial hemp from the list of controlled substances. However, it breaks it off from other cannabis products. So those other products, including marijuana, would remain on the list. States will be responsible, if I'm reading the information in the Farm Bill correctly, for establishing a plan to monitor, test, and enforce penalties around hemp production. Basically, it seems like it's going to be kind of a 3 strikes you're out program. If you have a crop that has THC levels above the 0.3% in 3 out of 5 years, you'd no longer be eligible to grow industrial hemp. However, until state laws in Oklahoma change, we are still a pilot industrial hemp program state at this time. So nothing has changed from what has been presented in some of the hemp webinars that you may have seen. It's still, to use Dr. Farrell's words, it's still not legal until it's legal for commercial hemp production. And just to touch briefly on rural development, because of the overlap this may have with other programs, you have Farrell's words, it's still not legal until it's legal for commercial hemp production. And just to touch briefly on rural development, because of the overlap this may have with other programs you have in your counties, there's some funding to address opioid crisis and rural mental health that I think we'll see more information about. There's continued support for rural broadband development, and there's also funds for infrastructure, hospitals, water systems, and schools improvements in the Farm Bill that may become available through various agencies. So finally, just to do some comparison to the previous Farm Bill, you can see there's a little bit of an increase there in the commodities. What this is really associated with a couple of things. One is that cotton came back in through the Bipartisan Budget Act as a covered commodity. And so they had to come up with the money to cover that. And then also this yield update that's going to happen. Both of those things increase the expected payments under the commodities title of the Farm Bill. That was partially offset, of course, by that land that has been continuously in grass that is not going to be able to sign up under ARC and PLC. Also, trade expanded. That's trade promotion programs, trying to find new markets for U.S. agriculture. You see a big drop in rural development. That's associated specifically, I think, with a program for rural electric, some sort of a savings program. They changed some of how that worked. I think that's where most of that decline comes from. Some increase in research and extension. We talked about some of those research areas that were in the Farm Bill. And then also some increase for energy and some biofuels programs, horticulture. A little bit of a decrease in crop insurance was expected under this Farm Bill. And then that increase in the miscellaneous, $300 million of which is those animal health programs, for a net very small increase in expected cost as compared to the prior Farm Bill. So next steps. We're in a bit of a holding pattern right now. The federal shutdown that includes USDA, and certainly I realize that not every USDA employee is currently furloughed. There are a lot of USDA employees that are still working. They're just not able to be paid until there is a federal budget for that. But we've got a lot of USDA employees under furlough. I'm sure you guys have heard, and I hope you've been encouraging your producers to talk to FSA during these 3 days that they were open. Today is the last day that they're going to have offices open to deal with critical requests associated with farm loans, for example. So we're going to be waiting a little while until we can get details on these farm programs. And I suspect this shutdown will cause a bit of a delay in how soon we'll see those details as well. I'm sure they're going to hit the ground running, but they're going to have quite a backlog of work to get through. The other thing I would say is that January 31st and February 11th at 6 p.m. we've set up webinars, and I mean the 3 area economists and myself, and here are the counties participating in those right now, so producers can come to a central location and watch an update, a more detailed update